Hi everyone, Mike Flores here, co-founder of Trade Prosper. Let's talk about what's on everyone's mind. Is the market due for correction? We're hearing about this all over the media lately. Let's take a look first at the fundamental picture. First, on a positive note, consumer confidence has just reached new post-recession highs. This is obviously good for the market. The ISM manufacturing survey continues to rally and just made new highs at 59%. This is important because economists look at this to see whether the economy is strengthening or not, and 50% threshold is the really important level that they look at. And as you know, 59% is way above 50%. The US leading economic index is rallying strong above its long-term moving averages. Now that's important because when the market normally gets weak, the US leading economic index normally crosses below its long-term moving averages. Now on a negative note, the advanced decline line started this month making strong highs. However, this week it has weakened considerably, so we will pay attention to that. Volume on the exchanges has dropped at a considerable pace as price action continued to make new all-time highs. This is also a bearish thing. Now, let's talk about famous market analyst Mark Cook, who also happens to be a market wizard from the book Market Wizards by Jack Schwager. Now, I want to talk about Mark because when Mark talks, I usually take notice. Now, why? Well, Mark has had a pretty incredible career. He's had years where he's made over 300%, over 500%, over 1,000%. So when he talks, I like to listen. Now, Mark has made his own indicator called the Cook Cumulative Tick. Now, he built this indicator back in 1986, and basically what it does, it takes the tick data from the New York Stock Exchange and compares it to stock prices. Now, why am I telling you all this? Well, because this indicator has helped him call the crash of 87, the crash of 2000, the crash of 2007, and the bull market of 09. So whenever you hear Mark talk, you should probably listen. Now, Mark says only 3 times since he's had this indicator has he seen a huge radical divergence in it. And that happened in 2000, 2007, and now. And he's saying now is the largest divergence he's ever seen. And as a result, he's calling for a 10% correction in the Dow sometime between now and October. And he's calling for a 20% reduction possibly in the next 12 months. Now, something to note, since 1964, there have been 18 fall declines of over 10%. And in 10 of those 18, most of the damage was done in the month of October. So let's pay attention to the market in these next few weeks and let's see what's happening. Now let's take a look at the technical picture. Looking at the technical picture, we can see that the market is well above its 200-day moving average, this pink dotted line here. We can see we had a correction back here. This is about a 5% correction, and now we've had about a little more than a 5% advance. Now notice how volume has gotten really strong on down days and really weak on up days. And notice we've made new highs on low volume. Those aren't good signs, people. That's a sign that the market is losing its strength. Also, the ADX, which is a trend indicator, has gone from strong to weak. It's now declining and below 20, which means the market is no longer trending higher. It's now going sideways, which we can see here in the price action. Important level to watch here is the 16,200 level, this swing low down here. We really can't say that the market's not in an uptrend until we break this level and close below this and the 200-day moving average. So for now, I think you still want to be long, but cautiously, and want to pay attention to this key level here in the market. One more thing I want to show you guys is the weekly chart. Now, we're going to look at the stochastics. Now, stochastics were created by a man named George Lane. And George created stochastics as a divergence indicator. People commonly use it as a overbought, oversold indicator, like they sell when it gets above the 80 line or they buy when it gets below the 20 line. That's not what the intended purpose was according to the creator. So let's look here at the divergence that I'm talking about. On July 14th, we see here that the market closed at 17,032. And the stochastic is at 94.83. Now, if we look at August 25th, we see the market closed at 17,085, but the stochastic is at 77.48. That's a divergence. The price went higher from July to August, but the stochastic went lower. So what normally happens now, we should see in the next few weeks, we should see the price of the Dow go lower. That's the way that stochastic divergence works. So this is something for us to take notice of, and remember, pay attention to that key level, the 16,200. So there you go. There go my thoughts on whether the stock market is correcting and how and when and if it will correct. On behalf of Trade Prosper, I want to thank you for being here and watching this video with us. Please leave your comments in the comments section. Give your trading ideas, your thoughts, and your feedback. Thank you guys. Have a great one. Bye-bye.